If you like money and want to hold on to more of it, do me a favor, focus and learn this one thing: monthly cash flow. Today, we're going to deep dive into how you as a homeowner can master this crucial aspect of your finances. With recent shifts in the mortgage landscape, including a notable 1% drop in interest rates, now is a great time to explore how a cash-out refinance can not only help you manage your debts, but also significantly improve your monthly cash flow. This isn't just about making ends meet, it's about making your money work smarter for you. So if you're ready to discover how to leverage your home's equity to bring more money into your pocket every month, stick around. We're unpacking all you need to know about a cash-out refinance, a strategy that could be a game changer for your financial health. Let's transform your approach to money management and open the door to a greater financial freedom. This is information you will not want to miss. Welcome back to my channel where we explore ways to make your money work smarter for you. In today's episode, we're zooming in on the hot topic in the current economic landscape, leveraging a cash-out refinance to consolidate debt and boost your monthly cash flow. With mortgage rates experiencing a notable 1% drop recently, there's a lot to unpack. Whether you're a seasoned homeowner or new to the game, this video is packed with valuable insights, so let's dive in. First things first, what exactly is cash-out refinancing? Imagine you have a savings account in the form of your house. Over the years, as you pay your mortgage and as the value of your house increases, this savings account fills up. Cash-out refinances is like shaking or taking money out of that savings account and putting it to use somewhere else. Specifically, it involves refinancing your existing mortgage, the one that you owe, and pocketing the difference. Now, why is this relevant today? Let's set the stage with some context. Over the last few years, we've been in the golden era of low mortgage rates. However, they've been edging up quite a bit, causing some anxiety for potential refinancers. But here's the good news. A recent 1% drop has made this option attractive again. Even though rates aren't as low as they were a couple years ago, it's like finding a sale at your favorite store. The prices aren't as low as they were on Black Friday, but the deals are still worth considering. Let's talk about the magic of consolidating your debt through cash-out refinancing. Imagine juggling multiple balls: a credit card, a car loan, maybe a personal loan, a mortgage. Each of these balls is a different size and weight, symbolizing various interest rates and monthly payments. What if you could exchange these for just one, and it's the easiest one to handle? That's what debt consolidation through cash-out refinancing does. It rolls your highest interest debts into your mortgage at a lower rate, thus increasing your monthly cash flow and only having you pay one simple payment. The benefits are multifold. It's not just about reducing the number of payments you make each month, it's about reducing the overall interest you're paying. Credit cards, just for example, often have interest rates in the double digits, over 20% in most cases. By consolidating, you're cutting these rates down significantly, leading to considerable savings over time. This means more money in your pocket each month and a clearer path to financial freedom. You might be wondering, this all sounds fantastic, but am I eligible for a cash-out refinance? So let's dive into the key requirements, with special focus on one of the most crucial elements: home equity. Equity is a portion of your home that is truly yours. You own this. It's calculated by taking the current market value of your home and subtracting the amount you still owe on your mortgage. For example, if your home is worth $300,000 and you owe $200,000 on your mortgage, your equity is $100,000. Now, why is equity so important for cash-out refinancing? Lenders use equity as a measure of financial stability. It represents how much of your home's value is actually yours, free of debt. When you apply for a cash-out refinance, lenders typically want to see, a substantial amount of equity in your home. This is often set at a minimum of 20% of equity remaining after the cash out. So if you're taking out cash, you can't strip your equity down to zero. You need to leave a cushion. But why 20%? This threshold acts as a safety net for lenders. It ensures that you're not borrowing more money than your home is worth, protecting both you and the lender of the risk associated with market fluctuations. In a volatile market, If home values dip, having less than 20% could put you in a precarious position, potentially owing more than your home is worth. Clearly, we don't want that. This requirement also serves as a check on your financial health. Maintaining a healthy amount of equity in your home indicates responsible financial management and a commitment to your investment. It's a way for lenders to gauge how you handle large financial responsibilities. Understanding and calculating your home's equity is a crucial step in addressing whether a cash-out refinance is a viable option for you. It's about knowing the value of your biggest asset, your home, and how can you smartly leverage it to your financial advantage. But remember, with great power comes great responsibility. Tapping into your home's equity should be done thoughtfully and strategically, always keeping in mind the long-term impact of your financial well-being. Credit score is another crucial factor. High scores usually translate to better interest rates. Think of your credit score as a financial report card, if you will. The better your grades, the more trust you earn from lender. And let's not forget about your debt-to-income ratio. This is all about balancing your earnings against your debts. Lenders use this to gauge your ability to manage monthly payments. The lower your ratio, the better chances of approval. All right, now that we've seen the potential benefits of a cash-out refinance, let's dive into how it actually works. The process, it's straightforward, but understanding each step can help you navigate with confidence. First, assessing your eligibility. Before you just dive right in, it's important to evaluate whether you're a good candidate for a cash-out refinance. This involves looking at your current home equity, credit score, debt-to-income ratio. Ask yourself, do I have enough equity in my home? Is my credit score high enough to qualify for a good rate? How are my current debts compared to my income? Second, the application process. After selecting a lender, you'll start the application process. This involves submitting financial documents like pay stubs, tax returns, bank statements, photo IDs. The lender will use this to assess your financial situation and determine how much they're willing to lend you. Third, the home appraisal. The lender will require an appraisal of your home to determine a current market value. There are some caveats to that, but 99% of the time it's going to be required. This is a crucial step as it affects how much money you can get from the refinance. The appraisal ensures that the loan amount does not exceed the value of your home. Fourth, the underwriting. Once your application is submitted, it enters the underwriting phase. Here, the lender reviews all the provided information to ensure everything checks out. They'll verify your income, your debts, the value of your home. This process overall could take a couple weeks. Fifth, approval and closing. If everything goes smoothly and the lender is satisfied, you'll receive an approval. The last step is the closing, when you'll sign various documents, including the new mortgage agreement. Be prepared for closing costs, which can include appraisal fees, attorney fees, and other administrative expenses. However, these are generally rolled into the amount and financed over the full term of the mortgage. It's important to get a loan estimate and go over this with your lender, your loan officer, and you're going to do that in the beginning stages. All right, number 6, receiving your funds. Once the closing is complete, the cash out portion of your refinance will be dispersed. The money can now be used to pay off your debts, improve your home, or however else you've planned on using it. Remember, each step in this process is an opportunity to make informed decisions. It's not just about getting through the process, it's about ensuring each decision aligns with your long-term financial goals. Let's paint a more vivid picture with an example. Imagine my man Jacob, a young single guy with a steady job. He's been juggling a mortgage, a personal loan, a few credit card debts. By refinancing his home and pulling some cash out, he can pay off a personal loan, he can pay off some credit card debt. Now he has one payment instead of 3. With the money he is saving monthly from paying off the high interest credit card debts, he can start investing into his retirement accounts. He can invest it into his savings account. The fact is he will have options that he can take advantage of with that additional savings. It's also important to consider some key factors to ensure you're making an informed decision. Let's talk about these in a constructive way, focusing how to navigate them wisely. Firstly, Let's discuss the mortgage term. When you refinance, you might opt for a longer term, which is going to create a lower monthly payment. Changing from a 15 or 20-year term to a 30-year term can be a strategic move, especially if it helps you manage your monthly budget effectively. However, it's worth remembering and understanding that a longer term will mean more interest paid over the life of the loan. Think of it as a trade-off. Lower payments now in exchange for a longer commitment. It's about finding what's the best situation for your financial needs. Another consideration is the ever-changing nature of the housing market. While using your home's equity can be a super powerful financial tool, it's smart to keep an eye on market trends. In a stable or rising market, your home's value is likely to support the refinancing decision. However, if the market dips, you could find your loan balance is higher than your home is valued. That would be a significant drop in values. This isn't an immediate cause for an alarm, but it's something to be mindful of. The key here is to approach cash-out refinance with a balanced perspective. It's a tool that, when used correctly, can significantly enhance your financial flexibility and well-being. But like any other financial decision, it comes with its own set of considerations. It's not so much about avoiding the risk, it's about understanding and managing them. To wrap up, cash-out refinancing offers a viable pathway for many homeowners to consolidate debt and improve their financial well-being. It's an opportunity to turn your equity of your home into a tool for financial stability and peace of mind. Remember, it simplifies your debts, potentially lowers your interest rates, and improves your cash flow. However, it's not without risks and costs, so weigh these carefully. If you found this video helpful, please like, subscribe, hit the notification bell for more content like this. Share this video with fellow homeowners who might be navigating similar financial waters. We love bringing you valuable content, so let us know what your thoughts are. Comment below on other financial topics you'd like for us to explore. Thanks for watching, and remember, every financial choice is a step towards your goal. Stay informed, stay savvy, and we'll see you in the next video. That's another guaranteed message.